It's 12:01. I'm going to be monitoring the chat. I'm going to turn it over to Richard Brooks. Richard is a SCORE mentor, expert on the financial side of it, and also on the hospitality side of things. So, Richard, take it away.
Thank you, Bob, and welcome everybody to this week's presentation on Simple Steps, which is financial management. This presentation is likely to run a little bit longer than 1 hour, and it's kind of like drinking from a fire hose, to be very honest with you. But I'm going to cover as much information as I can in the short period of time. Everybody who attends today's meeting, today's webinar, will receive a copy of the slides and a link to the recording. So you'll be able to review this, and you'll have the slides available to you to review at your own pace. For those of you who are not familiar with SCORE or don't have a SCORE mentor at this point, here's a image of our website. It's basically score.org/Cleveland, and you'll notice up here one of the top items up here, it says find a mentor. Just click on that, and you can look through all the mentors in our chapter. We have over 90 mentors in the Cleveland chapter. You can find somebody that has the knowledge and the skill set that you're looking for, and then just request that individual, and you can be assigned a mentor. We do it pretty quickly, so I'm sure that you'll be able to find somebody that you can work with. What does SCORE do? SCORE provides free face-to-face mentoring. We have 240 chapters around the country and over 10,000 volunteers. If we don't have somebody in the Cleveland chapter, we can find somebody throughout the country that can help you with your knowledge. And I've worked with several volunteers from other chapters, Nashville, Chicago, and a few others. And we have just a terrific core of people that you can work with. We do workshops, exactly what we're doing right now. We do roundtables. We're planning on doing something like that in the fall. So watch for some announcements coming up in the fairly near future. And then we can serve as an advisory board member. Advisory boards are different than boards of directors. Advisors generally are not compensated, and all SCORE volunteers are just that. We're volunteers, and we don't receive any compensation. So we can work as an advisory board, not as a board of directors. Okay, let's talk about what we're going to do today. We're going to talk about the importance of financial planning, financial versus managerial accounting, the three most important financial statements you will work with: the income statement, the cash flow statement, and the balance sheet. And I'm going to show you some examples of those. Understanding financial information, what are fixed and variable costs, and then how to determine a break-even point for your business. Break-even is where you're not losing any money and you're not making any money. And then finally, a little bit on financial modeling and forecasting. Financial planning and goal setting. This is really important. First thing you want to do is match your personal income goals with the financial plan to achieve them. Okay? So first thing you need to do is set out financial goals for you. What do I want to get out of my business financially? Do I want to make $100,000 a year, $150,000 a year? Can I get by with, in the first year, not making any money, or maybe only making $50,000 or $30,000? Talk about those goals, and then develop a financial plan that will help you achieve those goals. And the reason why you want to do this is to gain a better understanding of the financial risks and rewards that you will have in your business. Identify early development and startup costs, ongoing operations expenses, and funds needed to finance the business. One of the issues that SCORE has found, and basically it's been done through several research studies, most businesses tend to be underfunded when they first start, especially in operating funds. And so working with your SCORE mentor, we can help you identify exactly what you're going to need as far as funds, whether you can do it internally or you have to borrow money or you bring in investors to help you make sure that you have the funds that you need, and then have a plan to guide the business decisions and monitor the results. So you're going to develop a business plan, and you're also going to develop a financial plan, which is part of the business plan, and you're going to be able to monitor how your business is progressing. Are you ahead of your plan? Are you behind your plan? Why are you ahead of your plan, and how can you take advantage of it? Are you behind your plan? What went wrong, and how do you fix it? Notice here at the bottom, businesses don't plan to fail. They often fail to plan, and that's what's most important. Okay, let's talk a little bit about financial versus managerial accounting. Financial accounting is the process of recording, summarizing, and reporting a company's business transactions through financial statements. It's a historical look at the business finances. In other words, you're going to be looking backwards. What did I do last month? What did I do last quarter? What did I do last year? What did I do 2 years ago compared to last year? What did I do last year compared to this year so far? So it's a historical look at your financial records of your business. Managerial accounting is different. Managerial accounting is the practice of using the accounting information, basically from your financial accounting, from revenues to product inputs to outputs affecting the supply chain to support your organization, and then determining through your historical look what your future is going to look like. Unlike financial accounting, this is a forward look at your business using the historical data and business plans. Now, if you're just starting out and you don't have any business history yet, you're going to take your best guess at what you think you can achieve in your first year, your second year, and your third year. You want a 3-year forecast, although the third year is much more difficult to forecast. But in your first year, you'll do a forecast because that's what a lender and a investor is going to look at. The lender and the investor both want to know, can the business repay my loan? Can the business grow and in the long run pay dividends for my investment in the business? Okay, the financial planning process. Clearly write out your business and your personal goals. And I'm going to show you a method to do that in just a moment. Draft a business plan that achieves those goals. Keep in mind, your business plan does not have to be 50, 60, 70 pages. That's way too detailed. Most good business plans are roughly around 20 to 25 pages, including some financial information. Keep it as simple as possible, as high level as possible. When you sit down with a lender, the lender, like I said, is really only interested in how can you pay the loan back, and they're going to look at your marketing. They're going to look at your experience, your knowledge of the business you want to go into, and then they're going to look at the financial information. The rest of it is really for you. So develop a business plan that works for you as well as helps your investor, your lender understand what you're doing. Then you're going to create a financial model or models that support the plan. I generally ask my clients to do 3 financial models, a worst case scenario, a best case scenario, and one in between that they think is achievable. Test the plan in the financial model to make sure that you can make money. Maybe in the worst case scenario, you don't make money for 6 months, In the best case scenario, you don't make money for 2 months, but then everything is profitable from that point on. And maybe the middle plan is you don't make money for 3 months, and then you're able to go on. So, uh, uh, you want to test these models to see if they actually meet your business and your personal goals. You revise your goals and plan as necessary, revise the financial models as necessary, and then finally finalize the goals, the plan, and the financial model. And that's when you're ready to sit down with an investor or a banker, and your SCORE mentor will walk you through all of this and advise you on what looks right and what doesn't. Okay, let's talk about goal setting for a moment. We talked about it previously, but there's a really good way of doing that. And that is to set goals that are SMART. And SMART is an acronym. It stands for specific, measurable, achievable, relevant, and time bound. For specific, it accurately describes what you want to achieve. So, for example, a goal about income might be I want to make $50,000 in my first year. That's specific. Measurable. Are there clear metrics? What you don't want to say is I want to be able to draw a salary from my business. That's not clear. It's not measurable. What does that mean? A salary. Can the salary be $1? Can the salary be $1,000? So you want to be specific. Okay. So going back to the example I gave you just a moment ago, I want to earn $50,000 from my business in the first year. That's measurable. There are clear metrics, $50,000 that you can use. Okay. Achievable. Is it realistic? In the first year, is a $50,000 income to you achievable? Is it realistic, or is it just wrong? Relevant. Is it important to the success of your business? Well, if you're able to make $50,000 out of the business, that means that the business would have had enough money to support a $50,000 income. And time bound. Don't say I want to make $50,000 and not say, in the first year, because you can make $50,000, but maybe it'll take you 3 years to do that. So you want to have a specific goal, and you want to have a day or a date that you can achieve those. Okay. So, for example, by the end of year one, my business will have at least a $50,000 revenue, $10,000 in net profit, and have a customer satisfaction rating of 9 out of 10. That's an example of a really good SMART goal. Don't be confused on SMART goals in the sense of specific, measurable, achievable, relevant, and time bound, each having a separate goal. No. State a goal in one sentence, just like the slide shows here. So you notice by the end of this year, that's time bound, my business will have at least 50,000 in revenue, measurable, 10,000 in net profit, measurable. It's achievable, and it's relevant to the success of the business. The same thing with customer satisfaction, 9 out of 10. So use a SMART goal. And if you need more references on this, you can go into the internet, just type in SMART goals, and there are all kinds of websites that will show you how to create SMART goals. Okay, let's talk about the 3 most important financial statements you're going to need. Financial statements show you the financial status of the business for a defined period of time, and that's important to understand. So you might look at your income statement, your cash flow statement once a month. The balance sheet probably is not as important. It might be once a quarter or once a year. The balance sheet is just a simple snapshot of the health of the business at the time that you create the balance sheet. The income statement and the cash flow statement are actually working statements that you need on a regular basis, at least once a month. And you can, depending on the accounting system that you have, you could even pull the income statement and the cash flow statement sooner than that. So we're going to want to go into some detail on each one of these. The income statement shows you the company's income and expenditures. It also shows you whether you're making a profit or loss for any given period. The cash flow statement summarizes the amount of cash flowing into and out of your company. This includes all cash inflows a company receives from its ongoing operations. It can be cash, it can be credit cards, it can be whatever, and then external investment sources. Okay, so for example, if you make enough money and you have are able to put some money into a CD, that would be an external investment source. And again, the balance sheet contains a summary of the company's assets, liabilities, and owner's equity at a specific point in time. And the cash flow statement and the income statement are used in both financial and managerial accounting. The balance sheet is really just a financial accounting kind of document. Okay, let's talk a little bit more about the income statement. The income statement shows you the company's income and expenditures. It also shows you whether the company is making a profit for or a loss for any given period of time. And for those of you who are not familiar with income statements, I want to show you an example of an income statement. So what I'm going to do is I'm going to stop sharing. And I'm going to share again. Bob, can you see this?
Sorry, I was muted. Yes, I can see it. You're good.
Okay, good. This is a simple example of an income statement. It starts out with revenue. So in this case, we're looking at Ann's Nursery, and Ann has 5 classifications of products that she sells: large ornamental trees, in-ground ornamental vines, large potted ornamentals, small potted ornamentals, and various supplies. Okay. And her income statement for January, and we'll focus just on January here for this example, she made $2,500 in large ornamental trees, $2,500 in ground ornamentals, $2,800 in ornamental shrubs, $1,500 in small ornamental shrubs, and $2,500 in supplies. And you notice that Anna's broken down not only the dollar amounts, but also what percentage of sales each one of those is. And that's really important, because if you look over here in February, her large ornamental pots have grown from 23.73% of sales to 46.38% of sales. And then in March, it shrunk back down to 27.83. So there, if you were Ann, you'd want to know, why has my large potted ornamentals change as a percentage of sales so much? What happened during that time? Well, maybe in February, did Ann have a sale on large potted ornamental shrubs and sold a lot more than she did of anything else? Or maybe one of her competitors had raised their prices, she hadn't raised hers, and customers came to her to buy these because she was less expensive. But maybe her costs had gone up on that and she hadn't noticed it. So having the percentage as well as the actual dollar amounts really help you analyze exactly what's going on in your business. So in the month of January, Ann made $11,800. Okay. And here's her cost of goods sold. Okay. Um, uh, in for the large ornamental trees, $875. For the in-ground ornamentals, $625, $700 for the large potted, $338 for the small potted, and $625 for supplies. You can see the breakdown here. And remember the example I was talking about a moment ago, the large potted ornamentals. In January, her cost for these products, the cost of goods sold, was 5.93%, but in February, it jumped to 11.59%. So she's actually making a little bit less in February as a percentage of sales. So it's for this one item. So it's really important to have these percentages with you. Okay. So total cost of goods sold has remained relatively constant between January and February and March, which is good. Her gross margin, which is the difference between her revenue and her cost of goods sold, has come down to in January, she made $8,638. In February, she made $22,954. In March, revenue grew again to $42,258. And then look at her payroll. Her payroll is pretty consistent right across the board. And what that means is she's got the same number of people working the same number of hours every month. Okay. But notice here, her revenue is $11,800, but her payroll is $11,576. So her payroll is 98% of sales in January. Fortunately, in February, it drops down to 37%, and then 20%, 17%, 19%. So in January, Anne can look at this and say, should I have done something in January to reduce my payroll? Because considering all the other costs, Anne is going to know at the bottom of the income statement that she hasn't made money for January. And sure enough, let's look at some other expenses. She's got operating expenses shown below. Operating expenses are expenses that cannot be attributed to the sale of one item, whereas cost of goods sold is directly related to the sale of individual items. So cost of goods sold is also sometimes classified as variable costs, and we're going to show you that in a couple minutes again. Okay, so Anne has listed all of her other expenses. Okay, and down here, and your income statement will show what your expenses are going to be. This is just an example of what Anne has done. But your expenses may have other classifications in there. For example, you may have banking expenses in there. Anne isn't showing that as a separate classification. You may have credit card fees. If you're running a restaurant, you may have delivery fees. That would be the delivery fees would be part of cost of goods sold, but you may have other operating expenses. Utilities are often part of this. Okay, so then you have your total operating expenses and income before other expenses. And notice Anne had a loss for January, okay? And it was 88.97% of sales. In February, she made a slight profit, but in March, April, and May, Anne did pretty well. And then there are some other expenses. The amortization of her startup expenses, most startup expenses, not all startup expenses, but most startup expenses can be written off over normally 2 to 3 years. The government allows you to do that. It's a way of recovering some of the costs that you've spent to start your business. This only applies to business startups. And to determine what is amortizable and what is not, the best thing to do is talk to your accountant about that. Depreciation is also something that the government allows you to do to recover costs of capital goods. So, for example, in Ann's case, if she bought a tractor, she would be able to depreciate that over 5 or 7 years. And your accountant can tell you what acceptable depreciation is for any given item. For example, technology, the government generally suggests 3 years. For a tractor, it might be 7 years. If you're building out office space for your business, not in your home, but in an actual office building or a storefront, and you spend $20,000 doing that, the government would probably say you can depreciate that over 5 years. No cash is actually going out from your amortized startup expenses and your depreciation because you've already spent that before the business opened. Or in the case of depreciation, if you buy a piece of equipment 6 months in, you can depreciate that over 5 years or 7 years, whatever the government allows. But this is a way of recovering those expenses. And then Ann's got some commercial loan, a mortgage on her buildings, any credit card debt that she incurred. She's got a truck, so there's a vehicle loan there. And you'll notice that at the end, Ann made a loss of $12,496 for January. In February, even though she had income of $1,940, she still had other expenses that she had to pay off, $2,060. So she actually lost a little bit of money in February. Most people would look at this and say it's break even. Notice what happens in March. March, she actually makes $15,003 because she had 1,028 due in taxes. That being her tax rate on $16,031. In April, 23,256. Most businesses, you need to talk to your accountant about that question because goodwill is an intangible. And so the best thing you can do is talk to your accountant about amortizing goodwill. The government is going to be difficult on determining a value, but if there's a way that you can determine the value of the goodwill, it may be possible to do that. So this is what a typical income statement looks like. And what I'm going to do is I'm just going to scroll here to the end, and it should annualize for you here at the end. You notice that she made $397,000. Her cost of goods sold, was off of that. And then at the end, she ended up with a small loss, $3,600, because look what happens in September, October, November, and December. Nurseries are seasonal businesses, but this was only for her first year. So, by learning, by using her financial management and the financial records from her first year of operation, she can have a better opportunity to control her second and third year. The example I gave you, maybe reduce staffing in January and maybe reduce staffing in October, November, and December to reduce your costs. There may be other tools that she can use to reduce her costs and improve her profitability. Okay, and what I'm going to do now is we're going to go back. And I'm going to share slides again.
So Richard, while you're doing that, another question came in through Q&A. And the question is, how do we calculate cost of goods sold for a service-based business?
Well, it depends on a couple of different things. For example, if you're in the cleaning business, by the way, Bob, can you see the slide that says income statement?
Yes.
Okay.
No, it was up there and it's gone back. So
Okay.
I still see your spreadsheet. You had it and then lost it, but yeah, there you go.
Okay, good. Um, for example, if you're in the cleaning business, there are going to be cleaning supplies that you're going to have to pay for, and that would be included in your cost of goods sold. Okay. Another example is if you're in the cleaning business and you have 3 people working for you, that is in the cost of goods sold. Those would be direct costs to do the work, okay? To clean the offices or to clean the homes or to do whatever. If you're in the rug cleaning business, the shampoo would be part of the cost of goods sold. The labor would be part of the cost of goods sold. So those would be examples. If you're just providing a service, let's say that you're doing consulting, and what you're providing is your time, and you're taking a salary off of that, then that would not be considered part of cost of goods sold, and you would just jump right into your fixed expenses. Okay, good question. Let's talk now about the cash flow statement. Cash flow statements summarize the amount of cash flowing into and out of the company. This includes all cash inflows a company receives from its ongoing operations and, again, external investment sources. So what I'm going to show you now is an example of a cash flow statement. And cash flow statements differ from income statements in a couple different ways. Notice here, um, uh, we're looking at Ann's nursery again, and she had 42,000, or she started out the month of January with $10,000 in the bank, and that's really important to track how much money you have in the bank. Ann, by the way, wants about $10,000 in the bank every month. This way she can pay her payroll, she can pay for her operating supplies. This is what she's looking for. In this case, her cash sales were $4,000, and that was her total income. In February, notice that cash sales increased to $10,557, which is good, but and also allowed accounts receivable. And I'm going to advise you as best I can on this. If there's any way to avoid accounts receivable, do it. Do not be your customer's credit card, okay? Because look what happens here in March. $20,493 in revenue that was booked as accounts receivable. It's more than half of her sales. In April, accounts receivable jumps again to 62%. In May, 68%. And for small businesses, this is difficult. And the reason why is you are being somebody else's credit card. You are maybe having to pay interest. Your interest may be 18, 19, 20, 25, 29% on a cost to you. So whatever whenever you have the opportunity, the old expression, In God we trust, all others pay cash. That's what you want to do. Now, cash can also mean credit card because credit cards um, turn around in 24 hours to cash. You're not holding somebody's debt, which is what you're doing in accounts receivable. Okay, so then her cash outflows. Uh, she didn't buy any new assets. Uh, she wasn't picking up any additional inventory, at least for the period that you're seeing here on the screen. And her cost of goods sold were things like fertilizer and maybe gas for the tractor that she has. Those kinds of different things that would be in detail. And by the way, this is summarized out of a ledger that determines your that you where you record your operating expenses. So then her operating total operating expenses are 700 or $7,560. Her payroll, as we saw before, 11,576. And then her loan payments are $1,401. She wasn't drawing anything on her line of credit because she had the $10,000 in the checking account. So her total cash outflows $21,327. But notice up here, her total income was only $4,000 in cash, which means she ran, from a cash deficit point of view, $17,315. Now she has to make that up somehow. So what she ended up doing was she drew down, because she had a $7,315 deficit in cash. She drew down from her line of credit $9,815 so that she at least had $2,500 in the bank. Okay, so her line of credit balance now is $9,815. In February, what January says is that she had a negative cash flow in January. In February, it got a little bit better in the sense of she had more sales and her net cash flow improved to a negative $8,531. She had to borrow $8,531 to maintain the $2,500 in cash. Okay. And then in March, she was cash positive, net cash inflows of $3,498. Her operating balance improved. In April, same thing. She had 19,000 in cash. In May, in June, she continued to improve. And so the thing is, in April and May, because she had positive cash flow, she could have paid down some of her operating balance here, this 18,346. Notice she's paying interest every month on this. And so this is a tool to help you plan and actually see not only what your cash flow is, but how to pay your debts. And again, she's looking at all this with percentages. So that's why the cash flow statement is so important. It tells you whether you're bringing more cash in than you're spending, or you're spending more cash than you're taking in. Want to move right along now. Stop sharing for a moment. Okay.
So
And
Richard,
yeah,
I sent a link out to all of the spreadsheets that are available on the SCORE website. This one is one of those, the one
Good,
that Richard's been sharing.
good. Okay, let's talk about the balance sheet. I'm not going to spend a lot of time on the balance sheet. It contains a summary of information of the company's assets, liabilities, and the owner's equity. I notice here at the bottom the accounting equation: assets equals liabilities and plus owner's equity. Real quickly, I'm going to show you an example of Ann's balance sheet. What's up just a little bit? Okay. Now this is actually a 3-year balance sheet. Um, uh, uh, Her current assets are assets that she could liquidate very quickly if she had to. Okay, so she had at the end of the year she had 29,000 in cash, 3,600, almost 3,700 in accounts receivable. She had $40,000 in current inventory. Her prepaid expenses, a prepaid expense, for example, might be insurance, would be an example of a prepaid expense. Because she pays it up front for the entire year. Almost $11,000, and other initial costs, $667 dollars. So for a grand total of current assets of 84,340, and then she's got 40,000 in real estate, 57,000 in her buildings, equipment, 10,000, furniture and fixtures, $3,500, and her truck is $15,000. So she's got a total of $125,000 in fixed assets. For the year, those fixed assets depreciated in value by $7,979. So in total, her assets, which is the 84,000 and the 125, less the 7979, is 201,861. Her accounts payable, a little bit over $1,000. Her loan payments, commercial loan, mortgages, credit card payments. Look at the interest she was paying on the credit cards. Her vehicle loan balance, $9,231. Line of credit. Look at the amount of money she has sitting there in her line of credit. She needs to work that down as quickly as possible. And then her total liabilities, $155,000. Her common stock is worth $50,000. Her retained earnings were negative. Remember, we saw that she had a negative cash flow of $3,600. That sits right here. Her total equity, instead of $50,000, is reduced by the $3,600. So she's at $46,000. Add that to the $155,000. She's at $201,000. So she's in balance. But look what happens in year 2. Things improve significantly. She goes from 84,000 to 173,000. In year 3, 338,000 in total current assets. Her fixed assets remain the same. So look at the value of her assets jumps considerably, and look at the value of her equity over the same period. It goes from 46,378 to almost $300,000 in 3 years. So Ann did okay with this. Okay, so that's all you really need to see on the balance sheet. Again, you're going to look at it once a year, maybe once every 6 months. That's going to be it. Okay, want to go into something else now. We're going to talk about classification of expenses very quickly. You have fixed expenses, and fixed expenses stay the same no matter what. So, and I'm going to show you a couple examples of fixed expenses in just a moment. Your variable expenses increase as sales increase. So fixed expenses stay the same. They can be your salary. They can be other things that I'm going to show you a couple of examples. And then variable expenses increase depending on sales. So your utilities, your auto loan, your rent for your building, your office space, whatever it happens to be, the loan for your equipment, any fixed salaries, insurance, maybe your accounting fees, the things like that would be considered fixed expenses. Variable expenses are directly related to your sales. So commissions, your raw materials, shipping costs, any direct labor, any direct marketing for your business would all be example of variable expenses. Okay. It was important to review that because I want to talk about break-even point and a little bit about financial ratios and industry benchmarking. There are all kinds of financial ratios and industry benchmarking out there, and there are resources available to you. What is your cost of goods sold compared to other businesses of the same type as yours? What are your interest rates compared to your businesses? The cost of labor that you're spending compared to other businesses. So it's really important to look at this. And you notice that Risk Management Association and Dun & Bradstreet all have some statistics that you can look at to see if you're in line with the rest of your industry. Risk Management Association is a really good organization. They have tremendous amount of detail on this. So does Dun & Bradstreet. Both of these are subscription services, so you'll have to pay to get into them, except in the case of Risk Management Association and possibly Dun & Bradstreet, if you use the Cleveland Public Library, they have subscriptions to this and they allow you to use their subscriptions to look at this information. I want to focus now on break-even point because I think it's really important. The break-even point is the point in your financial business at which the gross margin you are taking in, your sales minus your cost of goods sold, is sufficient to cover your fixed expenses of running the business. In other words, you're not losing money and you're not making money. You're at zero. And that's a really important point to understand in your business. So in order to do that, let's talk about your gross profit margin. Well, what is your gross profit margin? We saw it in the financial statements a few moments ago. It's your sales minus your direct cost of sales. So for example, any commissions, if you have direct labor, if you're creating, you'll see an example in a moment, puzzles. And any direct labor involved in making those puzzles, manufacturing those puzzles, in shipping those puzzles, any shipping costs that you have. Those are all basically your direct costs of sales. And why is this important? It requires you to cost out what you're selling. It helps you determine the adequacy of selling of your selling price. Okay, and it helps you determine if you're going to make a profit or not. Most of my clients are restaurants and food trucks, and we spend a lot of time talking about costing out a menu. And the reason why is the food costs and the labor associated with that menu are direct costs of sales. And that's why it's so important for restaurants and food trucks to understand this, because they have to hit their break-even point in order to make a profit. So I'm going to give you a couple examples here. This one is actually, it came off of Ann's Nursery. I'm going to show you another one in a minute that's a little bit different. And here's the formula for your break-even analysis. It's the gross profit margin is equal to your total expenses, okay? Or your profit is zero. So your break-even sales number is equal to your fixed cost divided by your gross margin percentage. And so let's look and see what this looks like on the left side of the screen. In this case, the gross profit margin is $291,065. Total sales worth $397,100. So the gross margin as a percentage of sales is 73.3%. The payroll was $138,916. Operating expenses for other things that were, for example, her utilities, her other, the cost of her loans, her insurance, her bank expenses possibly, were 149,151. So she had a total fixed cost of $288,068 for the year. Her gross margin percentage of sales, as we saw before, 73.3%. Total fixed costs, $288,000. Her yearly break-even point, therefore, is if you take $288,068 and divide it by 0.733, you'll see her yearly break-even point is $393,012. Now, Ann's business is seasonal, and I'm showing you this as a seasonal example. In other words, if your business is seasonal, if some months are really busy and some months aren't, the best thing to do is look at it on an annual basis and then just divide by 12. So in this case, what Ann did was she divided $393,012 by 12, and that told Ann that she had to make $32,751 a month average to be in the black, to make money for the entire year. Some months she may be at $25,000 in revenue. Some months she may be at $38,000 or $40,000 or $45,000 in revenue. But Ann has a benchmark here of $32,751. And she knows that's what she has to make on average every month in order to be profitable. Here's another example, okay? This one is for a company called Puzzle Mania. And Puzzle Mania, their average price of their puzzles to their customers is $20. So they have their fixed expenses, which includes rent, telephone, insurance, salaries, internet services, utilities, whatever else it is. You notice it's $9,070. You can see that on the left of the grid. Their variable expenses is 49% of sales. Okay, so using this, let's look at the formula that we had before, okay? Their fixed expenses are $9,070. Their gross margin is $20 minus 49% of $20, which happens to be $9.80. Okay, so they're selling it for their puzzles for $20, and they multiplied $20 times 0.49 and then subtracted that. So in other words, $20 minus $9.80 gives them a gross profit margin of $10.20. So that means that they have to sell 889 puzzles in order to break even every month. Well, how do they get the 889? What they had to do, what they did was they divided the fixed costs of $9,070 by their gross profit margin of $10.20. And that gave them 889 puzzles a month. So if they multiply 889 puzzles per month times $20, that means that they have to have $17,780 in revenue. And here's their break-even point, $17,780. If they sell less than $17,780, they have a loss. If they sell more, they have a profit. And in the case of Puzzlemania, the reason why I'm showing this to you, this was done on a monthly basis, not an annual basis, because their business is fairly consistent across all months. So they decided to do this on a monthly basis instead of like Ann did, an annual basis and then divide by 12. So these are two ways of looking at the same thing. If your business is consistent, do it on a monthly basis. If your business is seasonal, it might be better to do it on an annual basis and then just divide by 12. Okay? Rounding the turn and heading home, folks. Okay? Financial forecasting, the business. What is a financial model? You want to create a financial model. It's a tool that represents your business idea with numbers. In other words, it's a tool that helps you look and see how your business is going to do. It helps you examine the feasibility of your numbers and evaluate variable factors. Labor. Should you be comparing 2, 3, 4 suppliers for your raw materials? Are there less expensive ways of doing some things? For example, using part-time labor for instead of full-time labor. Different kind of things like that. It's a model that helps you evaluate various alternatives. It's a basis of tracking your progress, because once you set up the model, you can compare your actual results against the model, and it's a blueprint you can adjust over time to achieve your financial goals. In some of the businesses that I worked in, we had a 3-month rolling financial model. So we would project out 3 months, and then at the end of month 1, compare our actual results to the model, and then we would update months 2 and 3, making month 2 the current month, and then projecting out another 2 months. So it became a rolling 3-month forecast. So it's a blueprint you can adjust over time to achieve your financial goals. And what are the steps to building a financial model? The first thing you want to do is identify your fixed assets, your operating capital, and your sources of funding. Okay, so fixed assets would be, for example, a vehicle. If you have a cleaning business, maybe it's your cleaning equipment, your vacuum cleaner, your scrubber, whatever it happens to be. Your operating capital is what you're using to finance the business over the period of time, and your sources of funding. Are you doing it all internally? Is it a loan? Do you have investors? You want to define all of those. Then you want to forecast your sales for your products and services to be sold on a unit by unit basis. So in other words, if you have 10 things that you're selling, you want to try to break it down as close to those 10 units as possible. What your unit of sales is going to be, what your sales price is going to be, and what your cost is going to be. And I'll use a restaurant as an example. If somebody orders a hamburger, your unit of sales might be the hamburger, some French fries, maybe a little side of coleslaw as well. That would be your unit of sales. The sales price would be determined, at $8, $9, $10, whatever it happens to be, and then your cost per unit. So you would determine your unit of sales, the hamburger, the French fries, the coleslaw, and then what your sales price is, and then divide your cost per unit into the sales price to determine your percentage cost per unit. In some cases, what you want to do is work on a fixed cost up front to determine your sales price. So in other words, what you would do is say, I want that hamburger to be 30% of my sales price. And so if you did that, you would take 30% of X using a little bit of algebra, and that would tell you what your sales price ought to be. So if your cost is, let's say, $1, you'd be selling it for $3.33. That would be a good way of explaining it. Identify your staffing requirements. Forecast if you will allow customers to have credit or not, because remember, if you're giving your customers credit, that's an expense to you. So you want to have the cash. Again, avoid credit at all, excuse me, at all costs, and then identify your other operating costs. Fixed assets, as we talked about, includes buildings, land, equipment, furniture, fixtures, vehicles, whatever. Operating capital includes your pre-opening costs plus operating capital to sustain the business for at least 3 months. In most cases, you want to have 4 to 6 months of operating capital, and then again, sources of funds. Your owner's equity, which is the amount, the value of the funds or the assets that you're loaning to the business, loans, lines of credit, and investors. Forecast sales, identify each item or service sold. We've already talked about that. Determine the cost of producing the product. This is usually 25 to 50% of the sales. Determine the sales price. Again, what you want to do is use that 25 to 50% as a measurement to determine what your final sales price is going to be, and then forecast the quantity for each one. Forecasting labor, identify what you are going to pay yourself on a monthly basis. This is really important. What you pay yourself is really important. A lot of people don't include that in their financial model. Make sure that you include that in your financial model. Identify how many full-time employees you need, how many part-time employees you're going to need, and what you're going to pay them. Be sure to include payroll taxes. Don't make a mistake on payroll taxes. And identify, and by the way, that also includes workman's comp, and then identify any third-party contractors. I want to just spend a moment with you on third-party contractors. You need to be very, very careful when identifying a worker as an independent or contract employee. The IRS has very strict rules, and the state of Ohio has very strict rules about workers who receive 1099 tax forms, which are independent contractors, instead of W-2 tax forms, which are employees. Okay? And I will give you an example of something. I had a client last year who was treating 100 people working for that client as contractors. And when we talked about all the requirements that the government has to define what a third-party contractor is, we determined that, in fact, the government was going to consider them W-2 employees. And what ended up happening there was the client had a huge tax obligation that we needed to then negotiate out with the government to make sure that the client did not have a huge penalty that the government was going to come after them as because they had to pay some taxes, some employment taxes, unemployment taxes, workman's comp, all these kinds of things that they did not pay because of independent contractors. So it's really important to understand what the rules are. Your accountant and your lawyer can help you with that. Be very careful on this. And then we're getting very close to the end here, folks. Steps to building a financial model, forecast other operating expenses after the cost of producing and the product of the service have been determined. These include, your advertising. Don't underestimate your advertising. One of the main reasons why businesses fail in the first year is they aren't telling their customers that they're there. Forecast your vehicle operations and maintenance, credit card processing fees, your loan repayments and interest, monthly rent, utilities, operating licenses, repairs and maintenances, operating supplies, and business travel. These are just some examples. You will have more than these depending on what your business are. With that, just want to quickly say this is what we talked about in our session today. We talked about a lot of different things, but it gives you a very high level to understanding your the financial information in your business. I'd like to take one or two questions, or if there are any questions that we can answer pretty quickly. If not, go to your SCORE mentor. If you don't have a SCORE mentor, just go to the SCORE website. You can either do it through score.org or score.org/Cleveland. That find a mentor link is there, and you just click on that and ask for a mentor, and SCORE will assign you a mentor. Any questions on this?
Nice job, Richard. So I'm not seeing anything in the chat. We've answered anything that came through so far in the chat, and in the
Okay.
Q&A, I answered a couple questions directly to the folks that were asking those.
Very good. Well,
So,
folks, I have a cold, and that's why I sound the way I sound. But I hope you all got something out of it. And the next session is going to be on funding. Next Simple Steps session is going to be on funding. It's really a great session, whether you need funding right now or not. Attending that session and learning about funding sources, because you may need it down the road, is going to be very, very helpful to you.
great. Richard, thanks so much. Well done. I'm getting a lot of accolades in the chat. So
Thank you
thank
all.
you, everybody, for joining us, and we will see you, I think it's next week, right? For
Yeah, I
the
think that,
last
yeah.
one.
Simple
Okay,
Steps 5, I think, is next week.
yeah,
Thank
see
you
you next.
all.
Take care.